Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are, and you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review it wherever you're watching or listening to it. With me today, I'm happy to have on for the second time from the team at Half Moon, Brandon and Eric. Guys, how's it going?
Yeah, good morning. How are you doing?
Doing great. I'm laughing because for those on the video, you can see Brandon just opened up the Dr. Pepper. I'll join him. I've got my Diet Dr. Pepper cream soda. But before we start talking Dr. Pepper, just quick disclaimer, nothing on this podcast is ever financial advice. Please consult an advisor. We're not providing financial advice, all of that type of stuff. Eric, Brandon, I was telling you guys before, I'm so excited to have you guys on because we're going to talk about Keurig Dr. Pepper, the ticker's KDP. You guys have a really interesting thesis. You've done really great work there, but I'm also personally excited because Dr. Pepper's been my favorite drink for 20 years. I was telling you guys, I used to have Dr. Pepper pajamas. I treat myself to a Diet Dr. Pepper, strawberries and cream. So I'm hitting the new stuff every night with dinner. And I'm really excited because we're taping at 10:30 and I can treat myself to a Diet Dr. Pepper at 10:30. So what's better? But Eric, y'all have done great work. I think you want to start by framing it. What's the thesis behind KDP right now?
Yeah, quickly, just kind of conceptualize what the business is. So it's about 60% of the business is the CSD, the beverage segment. That's anchored by Dr. Pepper. We also have 7-Up, Schweppes, and Canada Dry, which have a pretty dominant share in those subcategories. Across that segment, CSD segment, it's about 25% U.S. share. They've been growing share nationally and raising prices, but are only really now starting to see an inflection in terms of catching up with those margin headwinds. And the kind of overall growth trajectory has been low teens, and that is those tailwinds I think are just beginning to manifest on that side of the business. The other side is the Keurig business. That's the home brew kits and pods. That's about 30% of sales, about 34-ish% of earnings. You know, this has been the real area of kind of focus for the market, maybe fixation by the sell side and to a certain degree buy side. And that's been a result of softer homebrew appliance sales in Q1 on what were really tough comps, and also the Bed Bath destocking liquidation that's kind of now behind them. Historically, I think people looked at this as like, that's a big driver of the business. The reality is the actual appliance is negligible, if any, margin to them. The K-Cups themselves are where they make all the money. And their strategy there on the K-Cups has been gain market share of the homebrew segment and don't raise prices. However, recently they raised the price, the first we've seen in 5 years, other than one maybe in 2022, which I don't think has been noticed by the market. Meanwhile, there's been an inflection across that, the K-Cups and the homebrew appliances themselves in Q2, but also in the tracking data that we have so far in July. So heading towards a nice back half. In addition, some of the input costs have been moderating, which are further tailwinds to that side of the business. There's been a bit of a technical overhang, selling pressure from Mondelez, legacy shareholder, and as well Jab. Mondelez is now fully out as of early July. Jab has sold down what they had said they desired to, ending in June, and have stated no intent to continue selling for the time being. Meanwhile, the stock trades at historically wide margin to Pepsi and Coke. And we believe for some of those factors we mentioned, that kind of fixation on the coffee side and a lack of appreciation for the underlying drivers in the business and the upside to it, which we think will manifest itself over the next several quarters. We think it's worth $50, about 50% upside, given its trajectory, kind of the turn in sentiment that is kind of beginning to take hold following a solid Q2 and what looks like a solid back half.
Brandon, did you want to add anything to, I think Eric did a nice job with the overview, but did you want to add anything to that?
No, I think Eric touched on the overview and maybe like the setup there. I think they're at a really interesting inflection point here. So looking forward to diving into it.
Cool. I guess let's just start with the fundamental drivers. So I think y'all did a nice job, but you've got the Dr. Pepper, the U.S. beverage side. That's about 50. I think it's a little bit more than 50. I guess it depends how corporate goes, but a little bit more than 50% of the earnings are there. You've got the international side, which is about 10% of the earnings. And then you've got the Keurig, the U.S. coffee side, which is, it's actually a little bit under 40%, but I think those roughly are right. So Keurig, you've got this great razor blade model. And I think, as you said, they haven't taken pricing, but every time I flip through a sell side report or anything, I think there's a lot of debates over, hey, how much of Keurig has been like affected by work from home versus going to the office. There's all these debates on different cost curve trends. So what do you think the market's kind of missing on the coffee side?
Sure. I can hop in there if you want, and you can follow up. But yeah, so it was really interesting. Into the print, we like to track the K-Cup prices on a weekly basis. And we noticed they had actually raised prices on K-Cups. And that's really interesting in this scenario because historically they've been in the position to only lower prices. They want to get mass appeal. So it's kind of been just in the last couple of weeks, a big shift in strategy where they're no longer prioritizing necessarily just volumes as much as they are market share. So we think that's really starting to change the narrative. So just in the last, you want to look at like 2 years, the commodity cost of coffee has doubled. They haven't really passed that on. Now we're starting to get easing input cost inflation and pricing going up. And as you mentioned, some of the mobility, people were working from home, drinking lots of coffee. Now they're going to the office, they're going to Starbucks. They believe that headwind's going to be over by post-Labor Day. So Q3, we're going to be fully normalized, easier comparisons. And that's why we think this like 2H inflection point is really interesting, just because the coffee business has kind of cycled up big, then it cycled back down, and now we're starting to get more to a normalized run rate. But and I think the way we like to frame it is, if you look at 2019 today, everything's grown. Brewers, K-Cups, mid-single digits. So I think people maybe panic when they see 1 quarter of soft brewer sales, but realistically, it's on the right trajectory and taking market share. In fact,
I think on the Q2 call, the CEO said something along the line. He was like, look, we have 80% of the pod market. And if you believe that the trends are from people brewing whole pots of coffee to people brewing kind of by the cup, by the pod, then we have 80% of that market. And ultimately, like, we are going to be a growth market. And we're going to be a growth because we're going to benefit from that growth. Do you guys think that's the right way to look at it? Or are those trends kind of stopping or reversing?
Yeah, from a value and proposition, the discrepancy, coffee prices have been increasing. So people that brew at home, a whole pot, a pot cup, that's been, while K-Cups have been kind of flat in pricing, those prices have been going up. And then not to mention Starbucks prices have been increasing substantially. And also people are brewing and using K-Cups here platform in their office as well. So I think that is an offset. Maybe they have their first cup of coffee at home with the K-Cup, maybe you have another one on the way. It's something obviously people have every day. It's a ritual and have maybe multiple times a day. So I think that's adoption base is increasing, and that is driving it.
This on coffee, and this will come into play when we talk multiple stuff, but I think I've seen things that Gen Z tends to drink less coffee than millennials. And obviously that there's a little bit of an age thing. And I think millennials might drink a little less coffee than the people before them. There is some age to it, right? You're more likely to drink coffee at 30 than 20 and 40 than 30. But is there trends like, look, we've got energy drinks now, tea, all sorts of other things. Is coffee, not that it's a dead market, but, are there going to be maybe medium-term headwinds as those kind of demographics play out?
Yeah, I think in part, Brandon, that, yeah. Go ahead.
Yeah, so we it's kind of interesting. We looked at some of the industry data from the Coffee Association in the United States, which is really fun. So they kind of view themselves as the original energy drink, coffee. So that's kind of like their viewpoint. And I think they did some analysis, and I believe they found, I think it's 86% of U.S. adults drink coffee, and that actually in their survey data actually ranked higher than tap water.
No way, really?
It's 60% of Americans had a cup of coffee in the past day, more than any other beverage, more than soda. Tap water was 47%. Yeah.
But does that
I think coffee's here to stay.
But does that holds up over age, because you just said Americans, that holds up over like younger people? Okay, cool. Yeah. And then just turning over, and I just want to do it because like look, these are great businesses. And I want to just give some people some ideas of trends because they're good businesses, but especially on the U.S. beverage side, I do agree they're taking trends. This will come to valuation, but let's talk about U.S. beverage. They've released Dr. Pepper Zero. They've released some, Dr. Pepper Strawberry and Cream Zero, which I'm holding up for people who aren't watching the YouTube. They've done a partnership with C4. Basically, I guess what they're saying is the U.S. beverage business is doing really well. Do you guys want to talk about what's kind of driving some of the trends there?
Yeah, sure. I can start, Brandon, hopping as you like. So Dr. Pepper's kind of in its own lane. It's a kind of a unique brand. It's not a cola, so it's not directly competing with Coke and Pepsi. It's actually alongside Coke in many instances at the fountain. They have partnerships with them on the distribution side. So that's their adoption and growth of Dr. Pepper. Kind of its nascency was coming out of Texas and the South region. It's only really now fully expanding in some of the other regions. Yes, broadly available, but consumption is only accelerating in some of these other parts of the country. From a kind of overall beverage consumption standpoint, they have the diet offerings now, which they have in kind of all the different flavors. That's been tracking very well. And, some of their ancillary brands that they expand into on the energy side, as you referenced, that's been going really well. They have these JVs that they form to have a distribution agreement, marketing agreements with these folks. That's been going really well. And, one other point is the fact that they've been raising prices and seeing this negligible decline in consumption, demonstrating the elasticity of demand there. People are continuing to consume despite higher prices at the store.
Brandon, did you want to add anything there?
Sure. Yeah. So I think, Eric touched on it. It's really a regional soda that's starting to take make its way across America. And I think the cool part from being the Dr. Pepper, as you mentioned, it's a non-cola. It's actually the flavor category. So 90% of their distribution is actually what they call through the blue and red systems, which is Coca-Cola and Pepsi.
Yep.
So from their perspective, that's great distribution, and both Pepsi and Coca-Cola, they really want to carry it because that gives them a market share edge. Dr. Pepper being the number 3 player. So, our big call on Dr. Pepper and the carbonated soft drink portfolios here is right now they have, I think, a little over 24, maybe getting closer to 25% market share. We think Dr. Pepper's on the path to be the number 2 carbonated soft drink portfolio in the United States, essentially dethroning Pepsi. And we look at what's driving that, as you mentioned, their elasticity of demand have just been so phenomenal since 2019. So we kind of have that normalized base rate. Their volume growth is up 10% since 2019. Pepsi's is down 2.6%. So the trends actually for Pepsi in the last, we're going to call it year to date, are actually worsening, and Dr. Pepper's are holding up, if not improving. So they've really been a big net market share gain, and actually the biggest net market share gain in the last 2 quarters is what they announced on the earnings call. So I think when people look at the Dr. Pepper portfolio, it's the ginger ale, they have 75% market share. Orange soda, they're number 1 with Crush and Sunkist. These are just higher growth categories that are taking share from colas. Pepsi's kind of stumbled with being the number 2 player to Coca-Cola, and then Mountain Dew actually has not been doing very well in tracked channels. It actually represents the majority of their market share losses, which historically has been one of their stronger ones.
That's because all my friends aren't teenagers anymore. So, the Mountain Dew trends had to subside. Brandon, I want to ask you a question on that. So I knew Coke and Pepsi did distribution for Dr. Pepper, but I didn't realize that they would look at it as a competitive advantage. Like, I always kind of thought of it as a risk factor. And again, you guys have done way more work than me. I've only followed it loosely, but I always thought of it kind of a risk factor where if Dr. Pepper grew too much, like, look, it has to get sold, right? Coke could look at it and say, hey, why are we even giving the shelf space? Let's just take that shelf space. I understand what you're saying, but a lot of the beverage game is just having the distribution, having those logistics. Why wouldn't Coke at some point look at it and say, hey, if we just cut the Dr. Pepper out, or we're in 2020, I don't know if they could release their own Dr. Pepper style brand. They have done stuff like that in the past, but why wouldn't they eventually just say, hey, let's just cut this out and try and take that for one of our other drinks, or give up some lost sales and stop kind of funding a competitor?
It's so funny because, we recently read the book Fizz, which is the history of soda. So when we look back in the 80s, that's exactly what Coca-Cola did. They came out with Mr. Pibb.
I remember Mr. Pibb. Yeah. Not a big fan.
They came out with Cherry Coca-Cola. That's like their competitor to Dr. Pepper. And they just haven't really taken off and gained market share. I mean, Dr. Pepper's still the number 3 soda right now in the United States, depending on how you kind of look at it. So, in terms of shelf space, so I guess we had the opportunity recently to speak with the manager for Dr. Pepper distribution at Pepsi's Buffalo Rock facility, which is like their largest independent bottler and distributor. And they do the Southeast, which is big soda drinkers. So, when we're talking to him, he goes, whoever can get Dr. Pepper, essentially just, they have the edge in that market. They have majority market share. It increases your scale, increases your, SG&A leverage. You're doing more, you can hit more stores with more volume. So it's just like a huge advantage to whoever has the Dr. Pepper in that territory. Because Pepsi and Coca-Cola, generally speaking, are like, they're pretty close.
If so that territory you talked to, they've got the Dr. Pepper distribution right now. How often do the Dr. Pepper distribution regional agreements come up? Do you know?
Every year, and it's fixed pricing.
So, and then every year, can they just kind of like flip it and be like, Coke and Pepsi distributors, whoever wants us, whoever wants that extra market share, like come and get it.
Whoever wants, what do you mean?
Like, so you're a Pepsi guy you talk to. December 31st, his agreement with Dr. Pepper comes up. In October, can Dr. Pepper say, hey, we're doing a bake-off, you versus the Coke distributor, whoever's giving us the best economic terms is going to win? Like, do they kind of, every year, could they kind of look forward to bouncing each other off?
So they actually are. So I guess in that, okay, I understand the question. So yeah, so those are perpetual agreements. So when Dr. Pepper wants to, what they call is it refranchising, they actually have to buy out that distributor. And I believe they can buy someone out at any time.
I'm familiar with the bottom line. Okay, so they've got their distribution locked in. Got it. Okay, that makes total sense. And now, a quick word from our sponsor. Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are. And you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time. So at this point, and listeners probably came in thinking, okay, they're talking about Keurig, it's got a great brand, 80% of the pod shop. They're talking about Dr. Pepper. This is a branded drink. Like, they probably know it's a pretty good business, right? Like, historically, if you had bought Coke 100 years ago, you're listening to this podcast from the beach. So I guess my question here is, this is a 50 billion-ish company. It is widely covered. It's very large. It trades at 20x plus next year's free cash flow. So my question to the two of you is, I don't disagree. This is a really good business, but I know you guys are looking to generate alpha. I think my listeners are probably listening, not for investing advice, but thinking about generating alpha. How can you generate alpha at kind of 20 to 25 times on a good business, but ultimately a pretty low growth business, that type of stuff?
Sure. So, so on valuation, we're looking at it as like a little closer to maybe 16 times price to earnings. And to your point, it's a widely followed company. The people who follow it just don't like it. I think they kind of get bearish and focus on all the wrong parts. So I think for us, we kind of viewed this as, we're very opportunistic when we're kind of getting involved. It was everyone's pricing in the death of coffee. We're like, no, coffee is actually a really growing net market share gaining business. And I think that was an extremely contrarian call, kind of like walked the plank on that one. So we kind of got, I don't want to say lucky, but we're very fortunate that coffee kind of outlook held up there. So that's kind of like helped the stock recently. And to your point about outperforming alpha, I think we could have to run the numbers on it, but I believe over the last few years, it has, generated alpha versus the S&P 500, at least since they merged in 2018. Valuation is so interesting. We did this sum of parts analysis to kind of understand how, because this was a merger in 2018. So we said, what's coffee worth? What's U.S. beverage worth? Everyone kind of loves beverage, doesn't like coffee. So let's do this back in this implied valuation. And we sent it to a couple sell-side analysts. And I think within like a month, 4 of them had published this analysis. So it's just a way where I think we're kind of like adding new information to the market, or at least getting people to look at things in a different way. We shared that with IR, and they're like, "Oh, this is super interesting." And I think they maybe like even shared it with a couple of people. I'd say, where we also have kind of taken a maybe somewhat differentiated view is, there's just post-merger, there's a lot of intangible assets. For whatever reason, people don't add back other amortization expense, which is about a 10 cents benefit. So if you want to look at maybe like cash earnings here, there's just like a big discrepancy between CapEx and D&A. So you got to like neutralize for that. They were getting very aggressive on their supply chain financing. So they're actually winding that down. And that's going to be a big headwind to free cash flow over the next 12 months. But historically, their free cash flow conversion has been over 100%, where the comparables is actually like 80 to 90%. So it's a PE discount, but with higher free cash flow conversion. And, we like to focus on upside to earnings versus where we see upside to valuation multiples. Presumably that will trace that. So, when we look at what this business can do, gross margins.
Can I just dig into one thing? You said we sent around to a lot of sell side people some of the parts analysis, and within a month you saw 4 of them publish a similar sum of the parts analysis. What was in your some of the parts analysis that they were kind of republishing? Because to me, like beverage, international, coffee, corporate, slap a multiple on all those, I think that's pretty basic. Was there anything else you guys were kind of looking at or thinking about that the sell side hadn't done?
Yeah, so I would point to just the Wells Fargo, Morgan Stanley, JP Morgan. I'm forgetting any of them. But
any other big banks you want to list there?
Those are the guys who published it within a month, and everyone had the same sentence, which is coffee's trading at a mid-single digit, like either PE or EBIT multiple. And I think the only point that we made that what we did differently was saying, hey, at $32, everyone agrees with the valuation on cold beverage. It's outperforming by such a large degree. There's no really discount required. Let's back into what the current market price is implying for the coffee business.
Yep.
And I think once we kind of framed it that way and we said, let's look at Hamilton Brands, which is they make Keurig single serve coffee and small appliances. The valuations are actually somewhat similar. So we said, this is how the business is being valued and viewed. People are discounting estimates so much. And I think it kind of resonated with some people, and like, wow, that actually is an interesting way to look at things. And it would kind of like caught on fire pretty quick.
Eric, Brandon just went through a ton. Did you want to add anything to that?
Yeah, I think, how do you get paid here? What generates your alpha? I think the key catalysts are the inflection in the margins. If you look back to 2019, margins were 500 basis points higher. So as the coffee moderates, there's a 6-month lag because they have contract coffee and various other input costs. That's just only starting to get absorbed. And I think that's, accelerating. That's going to be a back half story here and then 2024 story. I think this kind of fixation on the decline of coffee, as mentioned, as relates to the brewer systems, that trajectory has changed. The narrative seems to be changing, kind of the bias towards that, and the marketplace seems to be changing. And I think that's kind of how you frame it. And then back to your question about like consumption trends, hot coffee being kind of the key. They recently announced or released a cold brew system, single serve basis. We have tested that, have one. Looks to be quite good, and that's adoption. It's been strong. So I think that's one way they can attack that side of the market to help stem some of those younger folks that like cold brew. We drink cold brew. So that's, I think one thing they've done in addition to some of these kind of, I don't call them free options, but they're recent JVs and other smaller brands to partner with that are growing really nicely.
I was reading the Q2 earnings and they partnered with La Colombia. And when they said that, I was like, oh, between Dr. Pepper and La Colombia, they've got my drink and they've got my wife's drink. They've got this household locked up pretty good. And C4 is another one where they've done, I think they just have a distribution agreement with them. I don't think they own that brand. You guys can correct me if I'm wrong, but I see those every gym I go to. I feel like I see somebody drinking. They've got like a Starburst branded C4 and then the Legacy C4. I feel like I've seen those. It's where Celsius was 2 years ago is kind of how often I see those, if that makes sense.
That'd be a great scenario. Yeah.
Yeah. They own 40%, right? C4. So they have these JV agreements whereby they get an attractive valuation, not taking over the company.
Yep.
The company's able to retain their marketing, brand, and product development, and can partner with a larger company with scale to assist with distribution and market penetration. And they've done that. That's kind of their blueprint. They've used it 3 or 4 times. And that's, exactly what they're doing with C4.
It reminds me of what Coke did with Monster in 2003 or whatever, right? Like that's what they did. And that's the thing. You stay an independent company, you focus on your brand, growing your business. And obviously distribution takes a huge fixed cost and a huge system. We can do that. And you kind of get the best of both worlds. Though eventually Monster grew so big that did become kind of an issue. Let me ask a different question. So on the Q2 call, the company comes out and says, hey, we bought back 7 million shares in Q2. And they say kind of the same thing you guys are saying. We see value in our stock. And when we see value, we're going to lean into the stock with repurchases to capture some of that value. But the counter to that is, Mondelez and Jab are both sophisticated corporate / strategic buyers in some way, shape, or form. And both of them have been reducing their exposure, have been selling over the past year. And I think the executive chairman's also sold a pretty substantial amount of stock over the past year. So, it's kind of interesting when you hear the company saying, we see value, and then you see these key control strategic shareholders or high-level executives who might be saying, actually, I kind of want to ring the register.
Yeah. So, I mean, that's a really interesting point. And that's been it's so funny, since they went public, that's been the huge overhang on the stock. Because every couple of months we get these secondary press releases, people kind of hit the panic button and the stock kind of like sells off. So we're thankful that that's now out of the way, no longer an issue. But Mondelez ended up selling their coffee business to Keurig pre-Dr. Pepper merger. So once these things merge, they're like, we're not in the business of owning other publicly traded companies. We own 13% of the company. We're going to work it down to 0 over the next few years.
Yep.
So that's all that's been going on there. They had a member on the board of directors who stepped down earlier this year. So it was kind of just it was a non-strategic holding for them. They kind of worked it down. On Jab, they had distributed. I mean, they bought Keurig. I want to say like 12 years ago. It was really early, mid 2000. So they had just distributed their final bit of stock to some of their LPs. And in their press release, in their Form 4, they said, that's our last distribution. We're long-term shareholders from here. They still own 30% plus of the company and have a few board seats. Oh, and I'm the executive chairman. So Bob Gamgore, we like him a lot. He did a great job as a CEO. They transitioned him to executive chairman, and then the CEO replaced him. Had a very, very short tenure. I want to say a month or two tops. Transitioned him back to CEO, and since then he sold off some stock when he wasn't the CEO. He became CEO, and thankfully those insider sales have stopped.
So it seems like he was kind of getting ready for retirement. And then he said, I had the eye go, ooh, who did I replace myself with? I might need to come back in and make sure the ship stays on course. Eric, did you want to add anything there?
No, I think kind of those are the key points I would say. Yeah, as it relates to Mondelez, their corporate needs. They didn't want to hold the public company stock. They can use that cash with their own business. And in Jab, it struck me as more of like a fund life decision to distribute to the LPs as opposed to a fundamental call on the business itself. And, if you look at where they've been selling, where they sold, they're, pretty inopportune and disorganized. They weren't in good communication with KDP. Presumably, if they were trying to maximize the price, they would have struck out to KDP and said, if you're going to do a share repurchase, buy our stock here, or something like a tender. But that's how that's played out.
Just one more question on multiple here. So U.S. beverage, it is taking share. It's growing nicely. Again, I keep holding up the Dr. Pepper Zero, but the Dr. Pepper Zero Sugar has done really well. They've introduced interesting brands. Like they're taking share there. The international business for Dr. Pepper is very small. And this is a brand game, right? People drink Coke because their parents drank Coke and their grandparents drank Coke. If you're international and you're going to launch Dr. Pepper, you might know it. I might know it. A lot of the listeners might know it. If international doesn't know it, you're launching a startup soft drink. Coke and Pepsi have a lot of their value comes from their international play, right? They've got the international brands. A lot of their value comes there. That's where a lot of the growth still comes from. I guess, can you give the beverage side of Keurig Dr. Pepper the same multiple that you kind of would give a Coke or a Pepsi when they don't have that huge international exposure?
So I think how we look at it is we're saying, hey, let's discount those two maybe by 10 to 15% for our implied valuation of beverage. And for the U.S., it's interesting that this really was and better being a Texas guy yourself. It really started when they had
Louisiana, but I'll take it.
Okay,
Dr. Pepper's Texas, but close enough. I
was in the ballpark. So it really started as a regional business, and now they're expanding it. A great example is in the Northeast. They just signed a new distribution agreement in 2020 that doubled their amount of distribution in the Northeast, the tri-state area. We're like, that's 20 million people right there. We're under penetrated distribution in the Northeast is still only represents, I believe it's low double digits percentage of Dr. Pepper drinkers. So it's really underpenetrated in the Northeast. But it is a U.S. focused business. They focus on where they can win, and they think they can win in the United States market. It's outgrowing some of the other guys in the United States market like Coca-Cola and Pepsi. And it's really at this point too, an earnings growth story as much as it is a revenue growth story. So Dr. Pepper has on the top line exhibited better pricing power, better elasticities. Well, where we're kind of looking at it is 2019 margins are still 300-400 basis points above where they are today. And they just inflected positively Q2 of this year. I mean, by 6 basis points. So we're kind of saying, you know, hey, this in the work that we've done, we think carbonated soft drink prices are going to be flat to up going forward from here. Volumes will be, you know, hopefully pretty close to flat, if not declining slightly. They've been growing lately. But you kind of look at that and now you have a low single digit growth top line, but we're going to keep scaling those input costs. And we think the earnings potential of this business is so drastic. I mean, sales are up over 30% since 2019. So we have a lot of SG&A leverage in there, over 100 basis points. We kind of put that all together to get to like maybe a 27% EBIT margin consolidated business, which is, you know, a few hundred basis points higher than the consensus estimate over the next few years. U.S. beverage alone for Dr. Pepper, one profitability advantage they have is they over-index to these, which is the 20 fluid ounce.
Yep.
These are single serve. They're the highest margin product for them, for the industry. And they over-index those. It's about a third of the business. The majority of U.S. beverage revenue is actually their concentrate sales. This is just selling the bag of the syrup. That's a 65% EBIT margin business, which is highly attractive. That's why U.S. beverage has 29% EBIT margins.
The 20 ounce just on it. Obviously, this is anecdata, not anything, but whenever I go to the Dr. Pepper down the Dwayne Reed down the street and get a Diet Dr. Pepper, you know, the Diet Dr. Pepper, no, it's in the fridge, but so they're providing you a service. And I think a lot of the margin is going to Dwayne Reed because they're charging that service, but I'm pretty sure it's higher margin for Dr. Pepper as well. Dr. Pepper in the fridge is always like $2.99. And then the 20 ounce, the 2 liter bottle that's on the shelf is $2.99 as well. And I always pay for the cold one because I just want a cold one and I want that hit right then. But I do think about that they probably works there. Do you guys want to talk about, you had a really interesting bottling thesis, piece of the thesis. Did y'all want to talk about that? Because I don't think anyone, I think on your recommendation, maybe one sell side person has kind of mentioned it, but yeah, I'll pause there. Did you want to start here?
So here's a bottle cap for the Dr. Pepper bottling cap right here. I don't know if the viewers can see it, but it says, bottled by affiliate of American Bottling Company under the authority of Dr. Pepper Snapple. So this is their bottling subsidiary, and it began in 1999 as a roll-up with the Carlyle Group. So private equity guys got in the business, saw a big growth market in soda, combined it with Dr. Pepper. And since the early 2000s, they've been rolling up all their other independent distributors and really creating a in-house bottling group. And when they originally IPO'd in 2008, they had a bottling group, and it was these guys right here. It's not what they do, though. They're marketing and more like a marketing business and a formula business than they are a manufacturer of sodas. So, you know, our whole thesis was these guys right now actually are trading more like a bottler than a high margin, you know, syrup and marketing business. Valuations have somewhat converged. Let's get rid of at least spin it out. Coca-Cola has a few publicly separated entities that have also done this. Let's get rid of that and just show the very best part of the business, which is what we do best, to get management to focus on that. So I think that's just how we're looking at it. And it doesn't, they used to say in the 10K, you know, we are more vertically integrated than our peers. They got rid of that language, and they used to break out the bottling revenue, which is in the billions. They don't longer do that either. So we think there's essentially like a $5 billion hidden asset value in this business that just no one's really paying attention to. And management has not signaled any intention of spinning it out, so we don't expect people to start paying for it yet. But, you know, if an activist ever emerged, I think that'd be one of the angles that they would pursue.
As we're talking, I think Coke, not Coca-Cola, Coke, C-O-K-E, which I believe a lot of Robin Hooders confused with Coke a few years ago. But they're a Coke distributor and bottler, and they're up like 15%, I'm guessing, on an earnings beat or something. But they trade for a very healthy multiple for a bottling system. I guess my pushback there, it's really interesting because, again, I've never even heard of anyone talking about the hidden bottling value in Dr. Pepper. And you are right, like Coke they've spun out especially their international side, they've spun out their bottling assets. Then sometimes they bring them back in, they go back and forth. But it's really interesting as a hidden value. My question would be, is it really, like, you tend to get hidden value where a company is just at the wrong multiple? Like, I think of a restaurant company, right? A restaurant company that owns all their land, and the restaurant company trades for 5 times earnings. And then one day they say, hey, we did a sale-leaseback And look, our earnings are going to go down because now we're going to have to charge ourselves rent expense. But we do the sale leaseback at a 5% cap rate, which implies a 20x earnings multiple. So your earnings go down, but you get like way more. If they like, we're saying the US beverage business should be worth like 18x. And I think a bottling business should probably be worth a little bit less than that. So if you spin that out, like you're going to have to start paying out to the bottling business. Is there really hidden value there? Or would that just kind of be a financial engineering spin and maybe a little value because it's a big business and people can like put the proper multiple on each of them, but is there really a lot of hidden value there?
Yeah, I mean, I think they could sell it for $5 billion. You know, maybe Coke Consolidated is up big today. Maybe they're trading actually at a higher premium. Not gonna have to dig into that one, but they actually are a Dr. Pepper distributor, a Dr. Pepper bottler. So seeing them go up 15% with a $6 billion market cap maybe makes us think that the hidden asset value on Dr. Pepper has maybe just increased a little bit, at least maybe 14%, like you mentioned. But yeah, I think they could sell it, and then just what they would do would be selling the concentrate to that new entity. And it actually is its own corporate entity, subsidiary called American Bottling Corporation on this bottle cap. So I think it's very, very doable.
Yeah, I mean, it's not like a financial alchemy situation. They would, depending on the value they realize for the sale, it's a much higher margin business selling syrups as opposed to the capital intensive nature of bottling and the like. So margin would almost certainly be accretive to on a margin basis, unlike say a sale leaseback where you're still having to pay someone to use that property in that situation of a restaurant you mentioned.
And I guess, yeah, I'm just not convinced because then you have to pay the bottling fees, but $5 billion would be a lot. And as you said, it would really clarify the margins and show people just how much cash flow this core business is generating. Is there anything else when obviously you guys talk to a lot of people on the thesis, your theses are widely read, as you said. I love that you sent the sell side, the sum of the parts, and within a month, 4 of them are doing it. Are there any other pieces of the thesis that you think either people are missing or that you guys have kind of engaged the most back and forth with people when you're discussing it?
And there was the Bud Light issue. There was,
I thought y'all did fantastic work here. I didn't know if y'all wanted to talk about it or not, but go ahead. Why don't you say it?
Yeah, there are a few days that are, following the Bud Light PR debacle where we're like, are we missing something? Are they somehow affiliated or associated with that? We found that it is like Clamato, essentially, it's like a mixed drink that they partnered with Bud Light on, which was getting hit as a result of that kind of brand version. And then dug into the numbers, and it only equated to like 0.02% of revenue. So, de minimis, inconsequential. And, I think that was one potential thing that everyone was looking to see what was the blowback across the industries related to those dynamics of, Bud.
This year has just been the year where it shows just how thick the left tails are in the market. Like, who thought a bank could blow up because they own too many long-term US treasuries? Who thought investing in AT&T, it might turn out that they were killing all of their customers and communities with lead? And who would have thought like Bud Light could do, send an influencer, $50, $100 worth of gifts and basically destroy, or maybe not destroy, but put at risk a lot of their brand value. Like it's just shown how thick the left tails are. But yeah, I just said you guys did such great work on it because again, I hadn't seen anybody even mentioned it. Obviously you guys said, oh, this could be a risk. When uncovered it, saw it wasn't a big deal, but I hadn't even seen anybody mention or think about that.
Right.
Brandon, anything else that you guys, when you kind of talk to bulls, bears, or anything, engage with, think it gets people really up about this, kind of the different pieces of the stock?
Yeah, I'd say one big inflection point that happened this year is kind of evolved too, was just earnings quality. I mean, that's usually where you get these debates with some of the bulls versus bears, as they say, they're driving EPS by doing these sale-leasebacks. And the sale-leasebacks have one-time gains, and they actually include those above the line. So it's included in adjusted EBIT, and people always kind of frown on that, kind of discount the earnings. This year, there's expected to be what they call above their long-term growth algo year. So they guided for 9% growth. This year, it has to be like 14% growth. So people are saying, they're not going to be able to do that without like some material one-time gains. So on the Q1 call, we got 5 million. And then on the Q2 call, we got 0. And they said, originally we were expecting to have 50 million one-time gains. Now we're going to have close to 0. So I think it really kind of proved the model and supported some of the bulls who thought that the earnings power is actually better than they had been fearing. So now we think people will be more comfortable kind of placing a full multiple, like a full PE multiple on these earnings, and hopefully close that discount with some of their bigger peers.
If I can just add one more, and it relates to that, you mentioned the factoring earlier, but Jab, who I think they've been unbelievable. Like if you look at their consumer holdings, I think we all probably just wish we had the Jab, like buy Krispy Kreme when no one thinks Krispy Kreme's good, buy Panera whenever, like they've been unbelievable. But, I do think there's something to people see Jab, this big consumer oriented thing that takes these brands and really spruces them up. And people might have like a little bit of echoes of 3G in their mind. And when you've got KDP, both with a lot of adjusted EBITDA, adjusted add backs in their earnings, and that big factoring thing, and you just look and you're like, hey guys, you're a tens of $billion company. Do you really need to be factoring your receivables from your bottlers? Do you really need all these adjusted? Like, I think the fact that those are going to be in the rear view mirror, it really cleans up the quality of the earnings, but I also think it just moves a little bit of that ick factor away from it, if that makes sense.
Yeah. I mean, we would email IR and be like, why are you guys still aggressive on your supply chain financing? I mean, the real answer is it's a performance metric for the management team.
Yeah.
So you're like in the proxy, they would say, we're going to push out our days payable to decrease our net working capital. And that is 30% of our bonus this year. We're like, that's not really aligned with the shareholders, but management's getting aligned to essentially work that. So we're glad that this year they actually, and then this quarter they announced, hey, we're no longer going to do that. It's a $600 million headwind of free cash flow. It's going to be maybe brutal on the way down, but next year we'll have a clean base and that'll all be normalized. So we think for the long-term health of the business, that was great.
Yeah, 100% agree. Yeah. And they're not the only ones who do it. It's like AT&T is doing it, and AT&T deals with a lot of smaller suppliers and stuff. So I get maybe you're solving some credit things. It's like AT&T, your investment grade. Do you really need to go factor your receivables? Verizon, your investment grade. Like, I understand you guys have a dividend you want to pay and you're worried about headline leverage and stuff, but making it by factoring, it's just, it's very strange. It's very strange.
Yeah. I mean, we told the company, like, you guys aren't Bed Bath & Beyond. You're not having a cash crunch. Like, you guys are doing just fine. Let's keep things, on track here. But if I could maybe just quick on earnings expectations for this year. So, I think the big message, why people are continuing to discount is the coffee inflection. We think that'll be good. The Q3 versus Q4 build, I think, is what people are really focusing in on. They somewhat lowered Q3 EPS expectations at mid-single digits, maybe even a little bit lower than that. So there's kind of like this Q4 build. When we look at what they did, guide for Q2 and delivered on Q2, it was so far above. So we're kind of looking at Q3 being similar. We think they're actually going to have it'll be more evenly split between Q3 and Q4 as people are fearing. And then what's interesting is when we kind of look at the exit rates into 2024, that would imply a somewhat material step up to earnings and run rates and everything like that. So I think it's going to have like a really good flow through. So when we see that, since December 1st, which was before they did this fireside chat and talked on expectations, the stock's down 15%. Earnings estimates are down not even 2%. The driving force behind that is cold beverage offsetting some coffee weakness. So we think that now the earnings revisions are actually starting to become positive. That'll start to close that gap between what the stock's been doing, what the fundamentals have been doing. And consensus at the low end of guidance, we're at the high end. So that's kind of where we're differentiated on expectations for earnings.
Eric, did you want to add anything to that?
No, I think that hit it. I mean, one other quick point about maybe points of pushback or tension in stock, probably about the category as a whole, is the fact people in probably our markets are saying, well, I don't drink sodas and, I don't see sodas served to kids. And yeah, that's fine. That's good. Well, the reality is the majority of the country still does. I mean, and there's a low sugar option or non-sugar option in the case of diet. And people that think about it, that they drink these, multiple times a day, they think of it as like a treat, so to speak, like instead of a donut, they'll have like Dr. Pepper, that's their afternoon snack. So, and that hasn't abated despite, health pressures, the well-known, vilification of sugar and stuff we agree with. But yeah, they have the diet's growing really nicely. And that's probably a good thing for the
Eric, I'm laughing because I felt so seen when you like people drink them as their afternoon treat. And as I said, it is my afternoon treat. There was right. For a while, there was the scary, like aspartame, it might cause cancer from the WHO or whatever. And I think if you looked at the research, it's like, yeah, if you drink 18 cups a day for a grown man, you might have like 18 cups a day every day for your entire life, you might have some issues, which if I could, I would, but I try to stay underneath that limit.
Yeah, that comes and goes, right? The aspartame
Yeah.
concerns and such. But
and as you said, like, I understand there are healthy trends, but there's a zero sugar option. People have been doing these for decades. It's a lifelong, I don't want to say habit. They can be addictive if you like really are drinking tons of them every day, but it's a lifelong treat. I don't think like the demographics on changing that are just so long. I think in the long run, there's the heat death of the universe. And that's probably what we're talking about coming out of that. Hey, if you guys don't mind, just really quickly, the last time you guys came on, I thought you did a great pick for Oxford. The business is doing well, maybe not quite as well as people thought at the beginning of the year, because I think they did a little bit of a pull down in their Q1 earnings. Just wanted to, if you guys have 2-3 minutes, just to see how you guys are thinking about Oxford, because I think that's a super interesting one as well.
Yeah, quick kind of high level, Brandon, feel free to hop in. But so the last quarter, they, again, beat numbers, but the guidance was softer. The cadence that they articulated was that March was a little bit softer than they expected. And then they even noted that April and May were subsequently stronger, but they gave a kind of soft Q2 guide. Tracking data we have and indications are, going to exceed those expectations. I think it was more conservative messaging and being kind of low on their guidance forecast relative to what, is probably the reality. Core business still doing really well, being Tommy and Lily is also. That has largely remained unchanged. There's some like capital allocation questions and we're going back and forth with them on, but margins start to inflect, paying down debt. Businesses aren't necessarily promoting, so maintaining those nice attractive margins. Yet it still trades like 8 to 9 times earnings. In a market where others are being forced to discount or aren't able to pass along price, they're demonstrating the strength of their brand and lifestyle, they call it, within their customer set.
I got my father-in-law a Tommy Bahama shirt for Christmas. I don't know if y'all factor that into this was last Christmas, but I just wanted to let y'all know.
And now a quick word from our sponsor. Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are, and you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time.
I think last time we recorded, it was like they announced the Johnny Was acquisition either a day or two before or a day or two after. I can't remember exactly. I was kind of, this is me personally, I was kind of like, hey, it seems fine, but you've got this great Tommy Bahama growth business. I don't know if you really need to like go buy another thing and have 3 brands under it. I always get a little concerned when you have these companies trying to run like 3 different lifestyle growth brands under the same thing. I'd rather just see a focus on one, let investors really focus on one. How are you guys feeling about the Johnny Was acquisition? Is it Johnny Was? Johnny White? I'm not quite sure. How are you feeling about that acquisition?
Yeah. So we agree. We prefer that resources and focus be on the core brands. We're still pretty early on in the Johnny Was acquisition cycle. They acquired them like late November. They're just starting financials. We'll give them some time to deploy their playbook, kind of the marketing schemes and direct to consumer kind of channels that they've shown that they can utilize really well within their core brands and help accelerate growth. There's a nice store opening kind of trajectory, of course, within Johnny Was, but it's the quality of that brand is attractive as Tommy, but it's also 10% of revenue. So, it doesn't derail the story, but I think time will tell, but so far it's been, okay, we'd say.
Yeah. It's more than just the distraction. Like I was almost hoping you got to the point where, hey, they were at the point where their balance sheet was, hey, we can just start buying back shares and you can get this like financial engineered levered playback story on Tommy Bahama growth, right? It spits off a ton of cash. We grow up, but we also buy back shares. Brandon, did you want to add anything to that?
Sure. Yeah, no, I mean, I think you guys nailed it. I think, a big thing for us was coming into the 2023 guidance was everyone was playing for this big negative They've been over-earning, over-growing. 2023 is going to be a down year. In fact, they guided for high single-digit direct-to-consumer growth, which is 80% of the business. They said wholesale is going to grow maybe 0%, which is like 500 basis points of net market share gains. So Tommy Bahama is just crushing it right now. Big beat on Q1, and they're going to grow mid-single digits this year. So when we look at some other players in the space who are trading at like mid-teens PE multiples, and we look at Tommy Bahama's growth in margins, return on invested capital, they're rolling out Marlin bars. We haven't had a new unit growth story for Tommy Bahama in like 10 years. If I just had to like ballpark it, they've been a net closer. So for this year of Tommy Bahama, the outlook has just been so so fantastic. And we kind of look at that business as being worth more than the current market cap, the more current enterprise value. So we kind of look at some of the other brands. It's like, sure, maybe those have maybe slowed from mid-single digit to low single-digit growth this year. I think where people really got tripped up was EBIT margins are coming down this year. We were kind of hoping for a flat to maybe slightly down. In fact, they're going to take it down maybe like 70 basis points, and that's just SG&A catching up. They scaled SG&A just so nicely over the last few years. They felt like they had maybe underinvested in the business. So he said, SG&A, expect EBIT margins down slightly this year, but then to inflect positively next year. Consensus is still not modeling that. They're still discounting it. So we think in terms of like what this business can do, it's going to be hopefully over $12 of earnings per share in 2024. We think they're on that trajectory. They've kind of proved they're not just a one-time COVID winner. So let's just really beat it up and say it's worth 10 times earnings. I mean, I think Deckers and some other like Gap are worth double-digit multiples, but
Crocs. I mean, if you talk about the multiple Crocs paid for Hey Dude, if you guys slap that on, I know apples to oranges, but woo.
You're like starting at 100, like maybe $120 per share is like your starting point for like a fair value for this business. And we think it's obviously worth much more than that. So it's just time to prove the story at this point.
No, look, I didn't tell you guys I was going to ask, but I knew y'all be ready. So that's what I did. Because I just think it's a super interesting story. I think, Tommy Bahama has a chance to be a real brand. It already is a real brand, but have real legs behind it. And, if I remember correctly, there were some sharp guys quoted in Barron's about a month ago about how Oxford Industries was undervalued. So I had to ask them while the sharp guys were on the podcast because it's a really interesting one. Eric and Brandon were quoted in Barron's on Oxford. So just for people who don't know. Anyway, guys, this has been great. I think we're close to the end of the hour. So I just want to say thanks again for coming on. Brandon, thanks for joining me in the Dr. Pepper party while we were here. Eric, I don't know which sort of shareholder you are. I
have a Keurig in there. I have a Keurig. I'll have to make up for this afternoon with my snacks.
I'll have a coffee this afternoon as well. But guys, I really appreciate you coming on and looking forward to the third one.
Excellent. Andrew, always a pleasure. Thanks for your time.
A quick disclaimer. Nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.